The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, and thanks for joining us for our December market outlook. This is Dave Clayman. I'm the CEO and co-founder of 12 Points, and we are going to give everyone just a couple of minutes to get on here. We've got about half the attendees we're expecting, so I'm going to put you on pause just for about 2 minutes here, and then we will get started. Thanks. All right, so it looks like we have most of our attendees, and we want to be mindful of everyone's time, so we're going to get started here. Thanks again for joining us today on December the 9th, 2021 for our December webinar, the annual investment outlook for 2021 end and 2022 going forward. For those of you who may not know me, I'm Dave Clayman. I'm the CEO and co-founder of 12 Points, and I'm joined today by Emily Rowland, co-chief investment strategist for John Hancock, a fine Boston institution. Emily helps to shape the investment strategy and guidance for Hancock, and she's going to be kind enough to walk us through their market thoughts going forward here today. We will have a question and answer session at the end. If you want to just type your questions into the chat box over here, we will get to them at the end of the presentation. Thanks very much, Emily. The floor is yours.
Fabulous. Thank you so much, Dave, for having me today, and to my partner, Ryan Fay at John Hancock, for helping put all of this together. I am so happy to be with everybody here, wrapping up 2021. What a year it's been. It's hard to believe it's even wrapping up at this point, and looking forward to 2022 and what the economic backdrop looks like, what that might mean for cross-asset investing, and to answer any of the key questions that all of you have going into next year. I am going to be presenting a few key slides from our flagship quarterly market outlook piece at John Hancock. It is Market Intelligence, which is what you'll see up here on your screen today. I'm going to make a few comments on the U.S. economy and U.S. equities. We'll move across the globe and highlight the dynamics that we see playing out internationally. And then we'll talk a little bit about fixed income and what the outlook is for your bond investments heading into next year. First and foremost, I think it's always important to talk about where are we as far as economic growth goes. My favorite way to look at this is to leverage the Conference Board's Leading Economic Indicators Index. I love this chart. First of all, it consolidates all of the important data in one place. And second of all, it helps tell me, where are we in the cycle? Are we in a recession? Are we in an expansion? Are we heading towards a recession? Are we emerging from one? And what you can see here is that when these bars trend from negative to positive territory historically, and this is going all the way back to the 1970s, that typically signals that we're emerging from a recession. Those might be periods where in a portfolio, we'd want to take a little bit more risk. We might want to overweight stocks versus bonds. We might want to allocate to more cyclical parts of the market or more economically sensitive areas. When the data is going from green to blue, that's typically a period that the data is decelerating. As it gets closer and closer to zero, that means the recession's getting closer and closer, right? And that might be a period where we want to think about de-risking. We might want to allocate to more defensive sectors in the market. Maybe we want to own some more bonds, which are safer than stocks, going into that type of an environment. The gray shaded areas are recessions. If you look all the way on the right-hand side of the page, you can see we are very much in green territory. The year-over-year data for the leading indicators just came in last month at 9.3%. That's awesome. In fact, just in Q4, we're seeing a nice little pickup here in the economic backdrop. Q3 was okay. Q3 is great. Data like services PMI, which gives us a read on the health of our services economy, just last week came in at a new all-time high. Some estimates for GDP growth this quarter are at the high single digits, right? That's really important to recognize the fact that the economy is chugging along nicely. We're firing on all cylinders today. What you will notice, though, is that the pace of the acceleration in economic data is slowing. So we reached a peak here in the teens on the leading indicators back in April of this year. If you remember, that was peak everything. We had peak stimulus. We had stimulus checks to the tune of $5 trillion out of Washington, D.C. We had the Fed not even starting to talk about moving away from this ultra accommodative monetary policy that's been in place since the pandemic. So we probably will never see data like that again in our lifetimes in terms of that huge acceleration coming out of the pandemic, which was helped by all of the stimulus. Now, heading into next year, the pace of the growth is slowing. It's not an overly bearish message. Like I said, the economy is still doing well. The leading indicators are still showing a positive direction, but we're simply not going to see that hugely stimulative environment that we saw this year. We're not going to see the Fed double the size of their balance sheet. We're not going to see policymakers in Washington pursue warlike fiscal stimulus like we did into next year. So for us, as we continue to watch this deceleration, the investing environment just becomes harder. This year, it was basically impossible to take enough risk to keep up. Wherever you took risk in 2021, you were rewarded. Next year, we just see things getting a little harder. We think it's more important to think about how you're invested underneath the hood. We think it's more important to have a professional investor helping you make those asset allocation decisions. I think about this summer, one of my children was on the swim team at our local pool, and she really wasn't very good, right? But I noticed that every time she came home with this stack of ribbons after these swim meets, you know, some of them said like participant on them, but she had all these ribbons. And I thought, well, this is a lot like investing since the pandemic. You've basically gotten a ribbon no matter what over since, you know, early 2020. We think that changes. This is more like the Olympics as we head into next year. And what it means is that you want to own quality stocks and sectors. Now, these are companies that can grow organically, even as the economic backdrop starts to normalize. They're companies with great balance sheets, good free cash flow, ability to maintain margins as input costs go up. So we want to start to embrace more of that quality element into next year, but we want to continue to pair that with some more cyclical parts of the market as this cycle continues to unfold, as the U.S. economy actually continues to do well. So it's really about preparing for this next stage of the market cycle, which we identify as the mid-cycle period. It gets a little harder, not a bearish message, but it's much more important under the hood to identify those quality companies to pair with those more economically sensitive parts of the market. Now, another reason that we remain constructive and we still want to own US equities into next year is because the fundamental backdrop still looks good to us. So here's the way to think about this. Over time, stock prices follow earnings. Okay, so stock prices follow profits essentially. And that's what we're showing here in this chart. So what I have here is the S&P 500 prices here in the green. And then I have next 12-month earnings estimates here in the blue. So this is what analysts on Wall Street are telling us in terms of what their expectations are for corporate earnings next year. And you can see that these lines tend to move together. So this tells us that earnings are really a very, very important driver of stocks. Now, yes, we've seen this, parabolic move higher in stock prices since the pandemic. But the good news is that earnings estimates have moved higher right alongside prices. So this, if you're familiar with a PE ratio or a valuation, or this is basically how you judge are stocks expensive or not, the PE ratio in the S&P 500 hasn't moved very much over the last couple of years because as prices have gone higher, earnings estimates have also moved higher. To us, this is a healthy picture. I wouldn't like this picture as much if the green line continued to go up and the blue line started to roll over. That's actually the type of environment that we saw in the late 1990s, where stock prices and sentiment kept moving higher, people kept bidding up prices, even though those fundamentals or those profits actually weren't there. This is a picture I like and a reason that we want to continue to own US stocks. Now, what about internationally? So right now we do have a preference for the US, and there's really two simple reasons for that. And by the way, we still want to own international equities in a portfolio. We just want to be very specific about what areas that we're emphasizing right now, and I'll get to that in just a minute. So in the US, we're seeing better, more attractive relative economic data. One thing we like to look at in addition to the Conference Board's leading indicators is something called PMI data, Purchasing Managers Indices. Their surveys are very timely of purchasing managers at manufacturing firms. And the way to read this is that anything over 50 is expansionary and anything below 50 is contractionary. So when we look at these PMI data, they appear to be sort of flattening out overseas. These are the 6 largest non-US developed countries that we've listed here. We have China on here as well, which I know is not a developed but an emerging country, but it's very, very important in terms of growth across the globe. So we've seen this big acceleration coming out of the pandemic and this sort of sideways action over the last few months. And COVID in particular has been a challenge in Europe. The other big challenge is the fact that China is slowing a lot. There's been a lot of issues plaguing the markets and the economy in China. You have challenges with their largest property developer, going bankrupt. You have increased regulatory pressures across a number of industries and sectors in China, which are weighing on growth. And then you have a shift away from some of these capitalistic tendencies or policies that have been pursued over the last number of decades in China. So a number of issues that are putting downward pressure on growth, and companies in Europe are actually more impacted by that than the US is. Because of their geographic proximity, their supply chains are more directly tied to China, and the revenues of European countries are more derived from China than US companies are. We still have a significant number of revenues that come from China, but it's more significant in Europe. So for all those reasons, that deceleration in Chinese growth has actually impacted European countries more. So PMIs in the US, almost near 60 right now, really the best around the world, and one reason that we continue to emphasize the US in portfolios. Another reason we continue to emphasize the US is back to that earnings or profit idea. So this is the same chart that I showed for the US, but for international markets. The green line here is the MSCI EFA. So that's a good representation of European countries, including also Japan, so non-US developed countries. And then the blue line here is next 12-month earnings growth for those markets. And while it's too early to call a deceleration in the earnings estimates, most recent data, even in addition to what I'm showing on this page, shows that it's looking toppy. It's starting to roll over. It's starting to reflect that decelerating economic growth environment overseas. And we're seeing the same thing as far as emerging markets go, which is shown here on this page. So not a terrible picture, simply a more attractive economic and earnings growth environment in the US. So what does that mean for us internationally? We want to stay away from the most economically sensitive areas and really rotate into those higher quality areas internationally, even more than the US. In the US, we want that mix of cyclical assets and quality. Internationally, we really want to look at quality. And so what we're doing is emphasizing those areas that are going to give you that quality bent. And I'm showing them here, areas like information technology, consumer discretionary, industrials. These all have really strong secular growth stories and great earnings growth prospects into next year. Areas we're avoiding are areas like financials. Financials are a very cyclical sector. They're very much tied to the economic growth backdrop. They're very much tied to the interest rate backdrop. And we simply think that financials are going to have a tougher time in Europe into next year. We're comfortable owning them in the US, but we're underweighting them in favor of these quality sectors internationally into 2022. So let's talk a little bit here about the fixed income market. And I think it's important here that we talk about inflation, not only as it relates to fixed income, but also as it relates to equities. Now, inflation is clearly persisting longer than most investors expected, longer than the Fed expected. You know, the Fed recently came out and said, we think it's time to drop the word transitory. Inflation probably isn't as temporary as we thought. And we're really seeing this, you know, persistent pickup in the data as we close out the year. Now, what we have on this chart here is our expectations for what inflation looks like going forward. So first, what happened? Why are we in this position right now? And that's kind of the red or orange highlighted area here. We just saw the biggest mismatch between supply and demand that we'll probably ever see again. So essentially what happened at the height of the pandemic is factories closed, companies closed their doors, they fired all their workers, they shed all of their inventory. And then pretty quickly after that, companies, the economy reopened, companies restocked their inventories or tried to, companies tried to bring the labor force back. Not only did they all try to do it at once, but then we also disincentivized some elements of the labor force from returning to work through government benefits, right? So you have this huge challenge on the supply side, not only in terms of goods, but also in terms of labor. What about the demand side? You know, we had this surge in demand coming out of the pandemic, initially for things like goods, and then for things like services as economies started to open and people started to engage again. So we have this surge in demand coming out of the recession. We have this very limited amount of supply. And if anybody here remembers their economics 101 classes, when you get excess demand and limited supply, there's your equation for inflation. And we're getting it in a really big way. So what's going to happen going on from here? I hate to introduce much math into this conversation, but I'll do it very briefly. So there's a concept called base effects. So think about mathematically the way that inflation is calculated. It's calculated on a year-over-year basis. So why are we seeing inflation at 4%? That's a huge number for inflation. It's because essentially a year ago, we were in deflation or disinflation, right? So the year-over-year data is flattered by the fact that the base is very, very low, okay? And that's a concept that's probably going to continue here for the next couple of months. After that, those base effects that were basically your best friend turn into your worst enemy as they move the other way, right? So the base effects become very, very high, or the base is high, and then that year-over-year rating starts to decelerate. So we think that that's a really important thing to consider, in addition to the fact that these supply chain disruptions are starting to see signs of unwinding. In other words, the economists that I work with are telling me that the bottlenecks that we're seeing are starting to ease, slowly ease, and that sometime in the middle of next year, we should return to more kind of normal supply chain configurations and more normal movement of goods and services around the globe. So this is really important because when you relate this or you connect the dots to your portfolio, inflation is the enemy of bonds, right? In fact, by the way, if you want inflation protection for your portfolio, it's actually right in front of you. You can find it in equities. Stocks tend to be the best hedge against inflation. And one reason for that is because their earnings, which we already talked about, are in nominal terms. They're not adjusted for inflation. Particularly parts of the market that have good operating leverage, meaning the ability to leverage high fixed costs in order to pass prices on to the end consumer. You find that in industrials, you find that particularly in areas like US mid-cap equities. Those parts of the market have actually done phenomenally well in periods where inflation's elevated. So stocks are really where you're going to be the best place to be getting your inflation protection. Fixed income can struggle because inflationary pressures eat away at those fixed payments that you get on your bond investment. So that's tough. In fact, you might end up looking at your statement at the end of this year and you might see a negative return for your high quality fixed income investments. That's really unusual, right? Because those investments are there as the ballast of your portfolio. In fact, if you look, I don't have a chart in front of me, over the last 25 years, there's only been 2 other times where your core or your high quality bond allocations produced a negative return. And those times were both periods where inflation was elevated and when interest rates correspondingly rose. So we actually see that dynamic as setting up for a much better environment into next year for high quality bonds. Still limited return potential. We think there's more that you need to do within a fixed income portfolio than simply own the highest quality bonds, because they're just not going to get you there in terms of yield potential. But we think next year should be a much better setup. And when we look back on those other 2 occasions where we saw negative returns for bonds previously, the subsequent years were always positive. So something to think about, not the right time to abandon that ballast of a portfolio heading into 2022. Now, what is our outlook for the 10-year Treasury yield? This is a key question that so many investors have today, and it actually all comes back to that first illustration I showed you, the leading economic indicators. The yield on the 10-year Treasury moves along with the market cycle. In fact, this is the leading indicators here in the green. This is the same chart I showed, just in a different way and not going back quite as far as that initial one, just so I could show you some of the detail here. But essentially what happens is that the 10-year Treasury yield bottoms along with the economy and then peaks as economic growth peaks. And this has held true over the last 20 years or so. If you look all the way to the right, you'll remember that the leading indicators peaked back in April of last year, this year, 2021. We expect that the yield on the 10-year Treasury probably also peaked back in the spring. We've gotten pretty close to retracing those levels, but we actually see yields really not reaching that high as the cycle progresses. We see yields actually sort of chopping around right around these levels as we enter this mid-cycle period, which is typically what happens in previous mid-cycle periods. So what does that mean in terms of investing? We talked about, owning 10-year Treasury, owning high quality bonds is important in terms of having that core or that ballast in a portfolio, but you've really got to do more than just owning high quality bonds, because they're not going to cut it, particularly given the inflationary backdrop. So you're losing money right off the bat, particularly if you're in cash or money market funds. Moving all the way to the other end of the risk spectrum, though, in bonds doesn't make a lot of sense to us either, because you're simply not being rewarded for taking significant risk in the credit markets right now. We've already gotten great returns out of the lower rungs of the high yield bond market, the triple Cs. We really want to be somewhere in the middle. Meet me in the middle as far as fixed income goes. So you can see here our preference is for areas that are going to give you somewhere around 2 to 4% yield. I know it's not exciting, but that's really where we want to be, and that's the sweet spot. Bank loans, higher credit ratings in terms of high yield bonds, double Bs or BA, whatever nomenclature you like to use, and then investment grade corporate bonds, particularly in the triple B space. This is kind of that allocation that's going to give you that return between generating yield and still managing risk within fixed income. And then finally, before we take questions, I would kind of close with a couple of thoughts here about sentiment. One of the key things that I continue to hear from the investors that I work with is that, clients are very skittish. They're very worried about investing in a market that seems to go nowhere but up. And, it makes sense. It's hard to feel good sometimes about putting capital to work in a market that really hasn't given us that reset that we need in order to buy the dip. And one thing that we look closely at is sentiment. Not only measures of consumer confidence and consumer sentiment, but also where are the flows going? Where are investors allocating dollars? And an interesting dynamic has played out in this recovery, which is that cash or money market balances have remained very elevated. And that's what we're showing here. So this green line shows you today's cash balances. You can see the recessions in the gray areas. So usually cash balances do go up during recessions. That's normal, right? Investors want to own safer assets. They get concerned. They want to be more defensive. But typically they come right back down after recessions. And that really hasn't happened this time. We saw it initially. We saw that happen initially, but then cash balances have actually started to tick back up. And to us, that tells us that sentiment is still very conservative. We're not seeing that overly optimistic view. We're not seeing that irrational exuberance that often typifies market peaks or bubbles. So that's an important message. And also, it's important to think about the fact that there's a lot of cash on the sidelines that's waiting to get deployed, which can also support the market going forward. Again, I think it's going to be a lot trickier. I don't think it's time to get totally defensive yet. I want to wait until there's a recession. I want to wait until the leading indicators are getting close to zero. But certainly from a risk management perspective, we would suggest paring back on risk, paring back on cyclicality, embracing quality, and embracing a balanced portfolio. As you can see on the right-hand side of the page here, it's a classic, right? It works every time. The 60-40 portfolio of stocks and bonds has gotten you close to returns that you're going to earn on stocks, but with much less risk, much less volatility over the last 20 years. We continue to think that's the ticket into 2022. So just to summarize our best ideas, combining that quality element with that value or that cyclical piece. We didn't talk about this, but when we think about where we want some offense into next year, it's US mid-caps is the place that we've chosen. Also a great place to get inflation protection as this persists. Internationally, we really want to look at quality, and finally looking at corporate credit in order to generate that return in a risk managed way as we move forward into this mid-cycle environment. So Dave, I'm going to go ahead and pause and stop there right now and turn it over to you to see if there are any questions.
Awesome. So I did see a couple of things coming through, and this is one. Someone just asked, is CPI a good index to gauge inflation of professional labor, i.e. consulting services or scientific analytical skills?
So in terms of measuring labor inflation, we look specifically at wage growth. So there's a couple of different ways to do that. There's average hourly earnings, which isn't just hourly. They actually take people's salaries and break it down to what the equivalent would be on an hourly basis. And then there's also the employment cost index, or ECI. Wage growth has picked up meaningfully. I don't know the kind of more detailed view on it. I could certainly see if I could dig into the scientific community Sounds like maybe someone on the call is looking for a raise. No, I'm just kidding. But we are seeing a significant pickup here, in terms of wage growth. We have a little bit of an out of consensus view on it. We think because of this transformation, and I hate to kind of ruin anybody's day with this idea, but this transformation to work from home is potentially going to deflate wage growth over time. So now workers, they want to be able to have flexibility. They want to be able to work from home. And we think that they might actually take a lower salary in order to have that flexibility. Recently, the CEO of Goldman Sachs came out and said, if you want to earn a New York City salary, you have to come to New York City, right? So I think a lot of people are going to feel that that's an unpalatable thing. Like they've already moved to like wherever, right? East Hampton, and they don't want to come back. So we think that people might actually take the trade-off of a more flexible work-life balance and potentially leave some wages on the table as we continue to kind of transform as a result of all the things that have changed in our lives because of the pandemic.
So someone asked a question. I'll let you answer first, and I'll see if I differ a little bit. Is there value to AAA bonds?
So the challenge in the AAA space, the highest quality space, is that there's just no yield there right now. And that's a big problem, especially considering the fact that, inflation's going to immediately erode the yield or the coupon payments that you're going to earn on the highest quality bonds. So we're staying away from that area. Again, from a risk management standpoint, fine, but we think that you'll actually be fine in investment grade corporate bonds. So we look specifically at the triple B space. You're going to generate a lot, not a lot, but significantly more yield there, and you're still going to have that risk management buffer that we want, and you're still going to be staying away from the riskiest parts of the bond market.
And the thing I would add to that is, I think 2008 taught us a lot about bond ratings and maybe the quality of the rating agencies themselves. So that's where I think a manager who is actually doing the credit analysis is super important. I tell people all the time, I'm not smart enough to analyze the bond market because there's, 80,000 credits out there to take a look at on a daily basis.
Yeah.
That's above my pay grade. So that's where I think a real manager comes in, and just doing it on your own is challenging to just look at the ratings.
Agree.
So, one thing I'll challenge you on, so your view that inflation is going to go away, or dissipate, I will say. We're big believers in the inflation story personally, and that's because the owner's equivalent rent component is just starting to heat up.
Yeah.
And we think there's a good chance that that's actually going to, since that's such a large component of CPI, that's actually cause inflation to accelerate in 2022. So I'm curious if you guys have any commentary on that.
Yeah, shelter, great point. Shelter is a big component. It's about a third of CPI. So that should have an impact as we see that perk up. Certainly it was, challenged as a result of the pandemic as rents went down. The other components, though, are going to decelerate meaningfully. So you see, used cars, hotels, airfare, all of those things. We think sort of come down to more normal levels, and it comes back down to those base effects. The math is very, very powerful. So we saw kind of the bottom of this core CPI readings about 1.3% in February of last year. So we think that the big numbers are going to persist into February of next year, which is longer than was anticipated. But we think that moderates. I'm not saying inflation falls off a cliff by any means. In fact, it may persist even longer than we think. That's certainly a risk to our view. But the math is a very powerful thing here as we move into next year. And I think there's a limit to how much acceleration you can see in that shelter component as well.
Well, I'll say 10%. We'll see.
All right. We'll see.
And then the last one, your thoughts. So obviously top portfolio ideas here. We agree with these very strongly. You and I have that pre-conversation that we really like the quality value space, the mid-cap space. The indices are obviously have become so heavily weighted to large growth. And if inflation is persistent, those tend to be the most vulnerable areas. How could that impact stock picking versus index tracking, so to speak?
Yeah, that's another great question. I think stock picking, especially as the indices have become so concentrated, is really important. And it's important to know what you own. You know, if you own a large cap growth index, you own a lot of a certain big technology companies. You know, you own a lot of Tesla, and that's important because some of those companies we want to screen out. We like quality growth. We don't like momentum growth. We don't like unprofitable companies that are trading at massive valuations. We just don't think that that's a strategy that makes a lot of sense going into next year. So, you know, I think stock picking is going to be incredibly important. I think there's going to be a big differentiation between the winners and the losers. And there was another element of your question that now I'm forgetting.
No, I think you covered that pretty well. Although that was
Yeah.
the large cap growth. So I'll make my last point, and then Emily, if you have any closing comments. But I think what Emily just said is key to 2022. Not a bearish view by either of us, but a view that knowing what you own is extremely important. The portfolios that we're seeing come across our desk from prospective clients are heavily weighted in the large cap growth category, anywhere from often 70 to 90% of their stock allocation. And that's just an area that has some susceptibility going forward and can use some screening. So knowing what you own, understanding that, and that's something we're happy to help with if anybody needs any screening on that. Anything else, Emily, that you wanted to add?
No, that's it. I think that's a great addition. And I just think, again, like, you know, congratulations for everybody that's on the call for being engaged and trying to know and understand what you own and for, you know, engaging also with a professional investor that can help with all that. I think that's going to be an increasingly important conversation into next year. And I wish everybody the best and appreciate you for having me on.
Now I have to send Emily $20 for saying that you need a professional.
No, more than that, please. We just talked about wage inflation. Come on.
Okay. Anyway, I want to thank everyone for taking the time today. I know we went a little over our normal time. Hopefully you considered it valuable. We look forward to being a resource for you. You can certainly reach out to us. And other than that, we will wish you all a happy holiday season and a healthy 2022. Thanks, Emily.
Thank you.
Thanks, everyone. Bye-bye.